Welcome back everyone. In this video, we're going to take a look at two of the largest tech companies in the world who have seen a major drop in share price after their latest earnings. Both Microsoft and Alphabet have taken a major tumble in one single trading session after both companies shared their latest earnings reports, which missed Wall Street's expectations. Microsoft in a single trading session fell over 7%, and Alphabet, the parent company of Google, fell over 9% in one single trading session as well. Both of these companies came out with their latest earnings this week, and Wall Street was not impressed with the results that they shared. So in this video, we're going to go over both companies, take a look at their latest earnings reports, discuss the results, and determine if now is the time to buy both of these major tech players after the latest drop in share price. But before we do that, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and of course on this channel we talk about the stock market, go over any major market news, and we track the progress of my personal dividend portfolio, which is now at a value at $159,000. So if we take a look at my personal portfolio, the largest holding in terms of market value is currently Microsoft. I own 82 shares worth just under $19,000. And we can see in one single trading session, that went down 7.7%. So Microsoft is the largest position in my personal portfolio. I am a big believer in the company, and they just released their latest earnings, and Wall Street was not too happy with the results. So although Microsoft surpassed expectations on the top and bottom line, the cloud revenue was lower than expected, and the company's quarterly guidance fell short of expectations. And if we take a look at the actual numbers, earnings came in at $2.35 per share versus the estimate of $2.30, so they did slightly beat on the EPS expectation, and total revenue for the quarter came in at $50.12 billion, once again beating the expectation of $49.61 billion. So overall, the top and bottom line did beat expectations, but overall the guidance going forward was lower than what Wall Street was expecting. With respect to guidance, Microsoft was predicting $52 to $53.3 billion in revenue for the fiscal second quarter, which implies only 2% growth in the middle range of this expectation. Analysts were expecting the guidance to be around $56 billion. So this is a major drop below the expected guidance on Wall Street, and was a leading contributor to the almost 8% drop in share price we saw in a single trading session. And another factor that led to the major decline in share price, and investors were not too pleased with the slowdown in growth in the Azure platform. So Azure revenue grew 35% in the quarter. This is supposed to be the future for Microsoft and one of the leading factors of revenue growth and net income growth over the next 5 to 10 years. So 35% quarter over quarter growth for most companies would be exceptional, but for Microsoft investors, they were not pleased. So this 35% growth was a slowdown from the previous quarter, which grew at 40%, and analysts were expecting a revenue growth for this quarter at 36.9. So the Azure network alone slightly missed expectations for growth, but overall, as an investor as Microsoft and having it as my largest holding, I'm still happy with 35% revenue growth in an off quarter. Microsoft has such a strong history of beating all analyst expectations for quarter over quarter for years in a row. So to slightly miss this expectation of 36.9% and coming in at 35, this does not scare me away, and I do not think it's warranting the major drop we're seeing in the company's share price right now. Microsoft is a very diverse company, and a lot of their other business segments actually performed very well during the quarter. Their Office commercial products grew 7% year over year, the same growth rate for their consumer products. LinkedIn had an excellent quarter, growing their top line by 17%, and their dynamic products and cloud service revenue was up 15% year over year as well, and their intelligent cloud grew revenue to over $20 billion, which was up 20%. So a lot of their other business segments did grow year over year by a decent rate. And in that quarter, Microsoft returned $9.7 billion to their shareholders in the form of share buybacks and dividends. So overall, the company does a great job of continuing to reward their shareholders by buying back more and more shares each and every quarter and paying out a growing dividend year after year. And if we take a look at their updated balance sheet, the company is in a great financial position right now with around $107 billion in cash and cash equivalents, and their total current liabilities are at $87 billion. So right now, the cash on hand alone can pay off all their short-term liabilities due in the next 12 months. And if we take a look, their total current assets, including their receivables and their inventory, are at $160 billion, which is way above the total current liabilities of $87 billion, so a very strong current ratio. And overall, this company does not have a lot of debt. Total liabilities for the entire company come in at $186 billion, and their short-term assets alone of $160 billion can almost cover the entire debt level for the company as a whole. So Microsoft has a very strong balance sheet. The company's in a great financial position. They're very healthy. They have a ton of cash to fund future growth, to expand operations, to acquire other companies. And overall, this company, although they had a quarter that was below analyst expectations, leading to a major drop in share price, it has not changed my belief in their business. I will not be trimming my position, and if the company continues to fall over the next few trading sessions, I may actually add to my position and continue to build it up, even though it's already my largest holding. The company's still growing at a very fast rate. Although the growth was below what Wall Street predictions were, overall I do think Microsoft will continue to be a market leader for many years to come. So they were only one of two major tech companies to share their latest earnings and then subsequently see a major drop in share price because the market was not too pleased. The second company was Alphabet. This is the parent company to Google, and I'm going to reference them as Google throughout this video. So they missed on earnings, YouTube revenue shrinked in the quarter, and the company announced they're going to cut their headcount growth by half in Q4. So they missed analyst expectations for both the top and bottom line. The revenue generated from YouTube actually declined in the quarter. Meanwhile, analysts were expecting growth of around 3%. And for the company's total sales for all their different segments combined, they grew revenue 6% year over year, which marked the weakest period of expansion since 2013. So other than one period during the pandemic, this was the slowest revenue growth quarter in the past decade. So it is a major red flag for investors. A lot of consumers and a lot of companies are reducing their advertising spending, and we can clearly see this is hurting YouTube right now. So earnings per share came in at $1.06 compared to the Wall Street expectation of $1.25, so a pretty significant miss on the EPS. Revenue came in at $69.09 billion compared to the expectation of over $70 billion. YouTube advertisement revenue came in at $7.07 billion compared to $7.42, so another decent miss in terms of YouTube revenue. Their cloud actually surpassed expectation, coming in at $6.9 billion compared to around $6.7 for the expectation, and their acquisition cost came in lower than expectation at $11.83 compared to $12.38. So we can see their cloud revenue, which of course the cloud infrastructure as a whole is a very strong growth driver for a lot of these big tech companies, actually surpassed expectation, which is one good sign coming from Google in this latest earnings. And in response to the company's weakening performance, Google CEO announced major cost-cutting measures across the entire company on a global scale, and he has the goal to make the company 20% more efficient, which could include slashing jobs and product cuts. And during this latest quarter, they also announced 3 major product cuts already. They canceled the next generation of its Pixelbook laptops, they cut funding to the Area 120 in-house incubator, and last month, Google said it would be shuttering its digital gaming service, Stadia. And overall, the company has had a problem of overgrowing by adding too many people to their headcount, and right now they've reached a total of 186,000 in the quarter, up from 150,000 last year. So the company added over 36,000 employees year over year. And they announced that the fourth quarter headcount additions will be significantly lower. So he does predict over the next quarter they will continue to add jobs, but they will not add jobs at such a fast rate they've been doing in the past, and their hiring process will continue to slow down going forward. And the CEO is quoted as saying, "Our actions to slow the pace of hiring will become more apparent in 2023, so I do believe going forward over the next few quarters the headcount number may continue to grow, but at a weakening rate." And now if we take a look at Google's balance sheet, they are in a very strong financial position, very similar to Microsoft. Overall, Google and all these major tech companies that we know, all the FANG stocks, tend to have very strong financial statements just due to the nature of their business. So if we take a look at Alphabet as of the latest quarter, September 30, 2022, they have total current assets of $166 billion, and a majority of that is actually in cash at $116 billion. Taking a look, their total current liabilities are only at $65 billion, meaning their current ratio is safely above 2 and very healthy over the short term. And taking a look, this is another company with very, very little debt. Total liabilities for the entire business, including their lease obligations, are only $104 billion, and we can see in cash alone, they have more than that on the balance sheet and on the books right now. So if the company were to choose so, they could pay off every single dollar of debt and still have over $10 billion sitting in their bank account. So a very strong financial position. They still have excess cash on hand to fund future growth, and I'm not sold out of Alphabet right now. Although I personally do not own them in my portfolio at this current point in time, I do like Alphabet as a company. I think they are the market leader no matter what, and I think even though we're going to have a slow quarter right now, We are going through the prediction of a global recession. Companies are preparing for economic slowdown. There is a temporary reduction in digital ad spend, but once everything begins to recover, corporations are going to go back to flowing billions and billions of dollars into digital advertising, and when they choose to do so, Google will be the market leader there and ready to take their dollars and produce the advertising services available. So overall, I think this company may be at a nice attractive level to buy the dip. When one of the major tech giants in the market falls over 9% in a single trading session, maybe an excellent opportunity to pick up a few shares, dollar cost average into one of the largest companies in the world that currently has a market cap at $1.24 trillion. So overall, in this episode, we took a look at the latest earnings from both Microsoft and Google, two of the largest tech names on the planet, two market leaders in their respective industries, and now would be an excellent opportunity to buy these tech giants on a major dip of 7 to 10% from their latest highs. So let me know down in the comments your thoughts on these two companies. Let me know your expectations for their future growth. Is this a short-term reduction? Are they going to continue to reduce revenue? Let me know your thoughts. I appreciate you tuning in all the way to the end. Please hit that like button if you already haven't done so, and I'll see you in the next video.